Hi, everybody. Thanks for coming today in the rain. We're going to have a great class for you. I have to update a couple things, but Ratan and Annamira are going to introduce themselves.
Awesome. Hey, everybody. How are we doing today? Good? Thumbs up? Yeah, let's go. All right. I hope everyone's been enjoying the rain this week. I know it's been pretty bad, but at least it's a little bit wetter than it used to be, which is very solid. I'm Ratan, by the way. I'm the president over at Blockchain at Berkeley. Today we're going to be talking about decentralized finance. I'll hand it off to Annamira. You want to hold this too?
Sure. Okay. Hi, my name is Annamira. I'm a junior. I'm also in the club with Ava and Ratan. I think that DeFi is one of the most interesting areas of crypto. It's like pretty much the area that I solely actually pay attention to. So I'm really excited to talk about it today. It's changing the world a lot right now.
Do you want to talk about what you guys do with governance?
Oh yeah. So one thing that you'll learn about today is that some of these protocols, which we call DeFi protocols, standing for decentralized finance, they're protocols that are built out of smart contracts and deployed on Ethereum for the most part. And sometimes those contracts are redeployed and they are governed by a group of people in a decentralized manner via voting through governance contracts, which we'll talk about more later. And in order to vote and determine what changes happen to the protocol, usually certain DeFi community members will have tokens that represent voting power, and Blockchain at Berkeley has some voting power in certain protocols, and Ratan and I are on a team of people who review proposals and think about changes to a couple of different protocols and then vote on behalf of that voting power. So it's pretty exciting. Can you hear me okay? Is this the right distance to hold it from my face?
Yeah, I think you're good.
Okay.
Awesome.
Why is Ratan's name?
Okay, thank you guys. Sorry, I just had to post the slides to the B courses so you guys could follow along while we're talking if you want. Before we start, a couple announcements. We have the mid-semester feedback form. Thank you to the 48 of you that have already filled it out. We're making great progress. So if, I think I said 75% of the class fills that out, then we're going to drop your lowest quiz. And I know you want your lowest quiz grade dropped, so please fill it out. You have the slides on B courses right now, so you can just click the link. It's a very quick feedback form, and it really helps us out. Already from your responses, we've learned that we need to talk slower for the rest of the course. So please, if you have any sort of concerns, anything like that, just fill out the form, and then you can write it at the bottom. We have discussion 2 due next week, so 1 week from today. Please get those in, because you also need to respond to 2 other people's posts. So you have a full week to do that. And then start thinking about what you want to write for your final paper. The final paper is super great. It kind of just is this culmination of everything that you've learned in the course so far. This semester, we're kind of encouraging you guys to write about something a little technical. So as long as you're comfortable with that, I think being able to write about the more technical concepts within this industry makes you way more knowledgeable about the topic itself. And you guys can obviously come to us with questions. We don't have official office hours. We kind of do office hours after class every week. But if you want to set up office hours to talk about your final papers and talk through the ideas you have, we'd love to do that. So just send us an email, especially if you're writing about something that you're not super comfortable with. The final paper is really meant to be a fun exercise for you guys to dive deep into something you're interested in. So just start thinking about it. I think a lot of you will choose your topic from today's lecture because a lot of you are interested in DeFi. So that's why we're mentioning this here, so that you can pay attention during today's lecture. But yeah, without further ado.
Awesome. Thank you. You guys hear me clear? Yes? Good to go? Solid. OK, so before I dive in, I have a quick question for all of you guys. How many of you have heard of DeFi before? Put your hand up if you have. OK, other question? Who has not heard of DeFi before? Don't be afraid. You can raise them up. Awesome. That's good to hear. So today, we're going to be talking about DeFi, which is otherwise known as decentralized finance. In essence, it's finance, but on the blockchain. I know that's a little bit overused, but that's what we're going to go with for today. So when we take a look at DeFi, the first question you got to ask is, what even is DeFi? I'm sure those of you who have heard of it have heard a lot of different varied things, everything from building on top of it to the price speculation to everything else. But really today what we want to do is boil down into what specifically is DeFi, how does it work, and where can you build on top of it. So the first slide that I'll show is this one right here. Today, DeFi actually broke $100 billion in total value locked for For those of you unfamiliar with total value locked, that's the amount of money that is currently locked in DeFi protocols. Back when I gave this lecture for the first time, that number was at 2 billion. So if that's some context, about a year ago, it's about 50x since then. And so essentially, there's a lot of different things, right? You guys might be a little bit confused by the emojis down here. Each and every one of these represents a multi-million-dollar project at some point. Some of them have gone defunct now. This one especially has gone defunct. But there's a lot of great things that are happening. And really the cool part about it is that if you have an emoji on your computer that you decide you want to make a multi-million-dollar protocol, the bar really isn't that high. At least it wasn't. But yeah, we'll dive into that a little bit more. Now, the other side of it is that DeFi is not all roses. You know, you take a look at it, and there are a couple thorns. So when you take a look at DeFi, we have everything from hacks that have been happening for the past year and a half to 2 hacks that have actually happened in the past 2 weeks alone, with over $400 million put at stake in the compound hack and over 20 million stolen by like an 18-year-old in Canada who decided to hack a DeFi protocol too. So this space is still somewhat of a Wild West, obviously a little bit less so than it was about a year ago. But there's a lot of great development that's happening, and today we're going to dive into it. So yeah. So what is DeFi? DeFi overall is the idea that finance should be an open, global, and interconnected system that enables people to achieve financial empowerment. Crypto has been around for about 10 years now. The Satoshi Nakamoto white paper on Bitcoin came out in 2008. But DeFi itself as a concept didn't really evolve until Ethereum came out with the MakerDAO protocol. You might be asking, why is DeFi so much more relevant than a lot of other areas of blockchain? That's because with smart contracts, you're able to empower people who normally didn't have access to financial tools to get access to those tools. And that's what DeFi enables you to do. It's something that has been termed as a sandbox of finance and has really enabled a lot of different concepts that previously were unable to be explored to be explored. And that's essentially what the overview of DeFi is. The first question we got to ask is, what's the difference between centralized and decentralized? A lot of you guys are probably familiar with centralized finance. That consists of your Robinhoods, your banks, your financial institutions, the Fed Reserve. But on the other side, we have decentralized institutions. So centralized institutions, essentially what they do is that the big part of it is the custodying of funds. So when we take a look at a common example, Coinbase, which is a centralized exchange, Coinbase custodies funds for people who want to trade them. So say you have some Bitcoin and you want to exchange it to Ethereum. What you do is that Coinbase holds a lot of Bitcoin and a lot of Ethereum. By a lot, I mean billions and billions of dollars. You may have one Bitcoin that you want to exchange for Ethereum. You'll say to Coinbase, hey, I have some Bitcoin, can you give me some Ethereum back? Coinbase has both, and they give you the Ethereum back. But what happens if Coinbase gets hacked? That's what the idea behind decentralization is. We want something where even if Coinbase gets hacked, or Coinbase decides, hey, I'm not going to give you your Bitcoin back, you're still able to get it. And that's only accomplished via smart contracts, which we'll be diving into later today. But yeah, that sounds good. I'm going to hand it off to Ava to start diving into the first pillar of DeFi. Any questions before I jump in here? Awesome. All right.
Thank you. Perfect. All right, so we're going to go into a couple pillars of DeFi. I'll start off with stablecoins. So what are stablecoins? Why do we need stablecoins? What's someone's first complaint when you mention cryptocurrency? Also, this is an old slide, so I did that from today, a little bit higher. So usually the first thing that you hear is, but it's so volatile. How do you know the price from one day to the next? How are you supposed to actually use it as a real currency? And so that's kind of why stablecoins came to be. The main goal is to have a cryptocurrency that maintains a stable value. So in the US, it's generally one USD to one crypto. In other countries, they have different ones. So one KRT in Korea, et cetera, et cetera. It can change, but essentially it's just one cryptocurrency, or 1 unit of the cryptocurrency equals 1 unit of the currency of the country. And there are many different types of stablecoins. And there's new ones that come up every day. So there's reserve-backed, which are sort of centralized stablecoins, which means they're backed by some sort of reserve of another type of currency. So you have USDT, USD, Tether, and then USD is coin. And then you have collateral-backed, which are decentralized stablecoins, so DAI, which we're going to jump into later on in the lecture. And so this means, so reserve-backed is kind of intuitive. It's just like, okay, we're telling you that we have $100 locked up somewhere, and we're going to mint you $100 worth of a cryptocurrency. So in essence, it's kind of the same thing as transacting with that locked up currency. Instead, though, you can do more cool things with the crypto. So you're basically saying, okay, I trust this company because they're telling me that they have the same amount locked up. And so that's where this crypto is getting its value from, is from this reserve of locked up currency. Collateral-backed stablecoins are a little bit more confusing. You have some sort of currency. So let's say I have Ethereum, cryptocurrency, and I am saying that I would rather be able to transact with some sort of stablecoin. So I can use my Ethereum as collateral, and I can lock that up using the MakerDAI protocol, and then they will mint me a certain number of DAI relative to the amount of Ethereum that I locked up. And there's usually something called a collateralization ratio, which we're going to go over what collateral is and how collateralization works. But essentially they're saying, okay, you want to be able to use my this $100 worth of DAI. We need to prove that you can pay that back and that you have the amount of money that the DAI is worth. So you lock up 150% of that in Ethereum. So you're going to lock up $150 worth of Ethereum, and you're going to get minted $100 worth of DAI, which is 100 DAI, $100. So $100 worth of DAI is equivalent to 100 DAI. And basically, if you want your Ethereum back, you just have to pay back your DAI. So you can use your DAI to do whatever you want with it, and then once you're like, okay, I actually want my Ethereum back, then you can pay back your collateral, and then you get your collateral back. So I get my $150 worth of Ethereum back at the end. And that's a brief introduction into what collateral-backed decentralized stablecoins are, and we're going to get into more examples later on. And then you have algorithmic stablecoins, which I think are the coolest but also the most confusing stablecoins, and they're not as tried and true tested as the other two. But essentially what you're doing with an algorithmic stablecoin is it's very similar to the way that a central bank works, in that you want to adjust supply and demand to make sure that the dollar maintains its value of the dollar. But in the case of an algorithmic stablecoin, you're adjusting the supply and demand between two different types of cryptocurrencies. And you're basically, one of those cryptocurrencies is going to absorb all of the volatility, and one of them is going to be the stablecoin, and it's going to maintain its peg. So UST is one example. You have UST, and then you also have a currency called Luna, for example. So these are two cryptocurrencies within this network, and you want UST to equal $1. Always, you want it to equal $1. You don't care what Luna equals. It can equal whatever it wants. It's like a traditional cryptocurrency that's very volatile. And in order to ensure that UST is going to maintain its $1 value, when the demand of UST goes up, you want to make sure that the price of UST doesn't also go up when the demand goes up. So when the demand goes up, you want to increase the supply of UST, right? Because demand goes up, you increase supply, it's going to maintain the same value. And to increase supply of UST, you burn Luna. So these two are connected. The supply and demand is directly inversely related. So when the demand of UST goes up, you burn Luna and you mint UST with what you burned in the Luna. And essentially, UST does not go up, but then the price of Luna is going to go up, right? And that's a side effect that we don't have to talk about, but that's essentially how you make money in these networks, is that if you believe in the stablecoin, you invest in the currency it's tied to, because when the demand for the stablecoin goes up, the price of Luna is going to go up. And then on the other side of the coin, demand for UST goes down. Not a lot of people are using the stablecoin right now, but you want to maintain the $1 value. You don't want that $1 value to dip below $1. You burn UST and you mint more Luna. So when you burn UST, the supply of UST goes down, which means that the price is going to maintain, keep its peg at $1. And then the price of Luna is going to go down. So the demand for the stablecoin is related to the price of the native cryptocurrency that it's tethered to, which is a basic way of explaining algorithmic stablecoins, but that's kind of the basis of it. And then these are decentralized, and collateral-backed are also decentralized.
You have a question?
We're going to go over the questions. Okay, so then we're gonna get into DAI, which is the collateral-backed stablecoin. And the premise of how it works is that you use a volatile cryptocurrency to get loaned stable crypto. So the example I used was Ethereum to get DAI. How do you do this? You put in more volatile crypto than stable. So you're understanding that Ethereum is a volatile asset. Its value changes from day to day. So if you want to use it to get DAI, then you need to give more of the volatile crypto just in case it dips really far down, right? So you're over-collateralizing whatever you're borrowing. And so the collateralization rate, which I mentioned earlier, is always more than 1. I used an example where it was 1.5 or 150%. And it's saying, okay, so like why would you put more? And I explained why you would put more, because you benefit from getting that DAI. So you're willing to lock up your collateral, knowing that if you pay back your whatever DAI you borrowed, you get your collateral back. You get your collateral back. So this is the example I walked through, but we can look at it on the slide again. If you have 0.24 ETH or $150, and you want DAI, then you can lock up your $150 worth of ETH, assuming that there's a 150% collateralization ratio, and you will generate $100 worth of DAI. And then that's it. And then you get your DAI, and all you have to do is pay back what you borrowed, and then you get your ETH back at the end of it. And then that's perfect in a perfect world, but we all know that there's always volatility. So if the collateralization ratio is 150%, that works when ETH is $150, but what if ETH becomes $140, or if it becomes $160 the next day, right? That's going to change the percentage that you have of collateral, because the value just dropped, but you still have $100 worth of DAI. So it just went from 150% to 140%. And then basically what happens is that if it keeps dropping to 130, 120, 110, if it hits a certain point where it's the same or less than the value of DAI that you borrowed, you get liquidated by the protocol, and that's all in a smart contract. So it's going to automatically sell your collateral to others for DAI, because it's going to want to maintain the amount of DAI that they have. And so you're going to lose most of your collateral, and then you lose money when that happens. And that's the gist of it with collateral-based stablecoins, is that it works well. You have to keep monitoring what the price of your collateral is at, because if the price of your collateral is dipping, then you're going to get liquidated, and you need to get out of that basically as fast as you can. And if you don't get out as fast as you can, then you lose money. So that's the catch with collateral-backed stablecoins. Okay, I just went over a lot with stablecoins. I actually took longer than I thought I would. But do you have any questions? Yes. It's a good question. So sometimes there's different reasons that people want it. Some people want the ease that using a stablecoin grants them if there's certain things that they want to do on a crypto network that they need a stablecoin for. A bigger reason I think that a lot of people do it is because they still want to maintain their exposure to Ethereum. They don't want to sell their Ethereum, but they also want to be able to use that money. They essentially, like, let's say I want to trade something or that would involve selling my Ethereum, but I think Ethereum's going to go to the moon. I do not want to sell my Ethereum. Then I can use it as collateral, so I'm maintaining exposure to Ethereum, right? It's still mine, and then I can mint some DAI, generate DAI, use it to do whatever I need to do, and then get it back, and then give it back to the protocol, and I get my Ethereum back, basically. And so I don't lose my Ethereum in the process, if that makes sense. Cool. Yeah. Any other questions? Yeah.
So as soon as it continues to just go up, then you won't have to worry about collateralization.
Exactly. So if you really believe in some sort of coin, then you can say, okay, I can use this as collateral because it's going to keep going up. And then you don't have to worry about it. You don't have to worry about getting liquidated. Yeah. Yes.
If you cover again why someone would be motivated in the first place to over-collateralize, so give more than what they get?
So you have to over-collateralize. You don't have an option. If you want to, in this situation where you're using collateral-backed stablecoin, you have to over-collateralize just because of how volatile it is. Yeah. Yeah. Yes.
So if the collateral just tanks, right, and it gets liquidated, is your dying tied to that collateral and that DAI is worthless, or?
No, so yeah, that's a good question. So if your collateral tanks and you get liquidated, you get to keep the DAI that you were minted. And your DAI is not tied to the value of, ideally your DAI is going to maintain its $1 peg, right? So your DAI is still worth what it was worth when you generated it. Awesome. We'll do one more question. Yes?
I was wondering how the collateralization ratio is set. How is it
I'll talk about that.
That's so funny. We were just talking about that. We'll get into that.
I don't understand what you mean by burn.
Burn? When I was talking about algorithmic stablecoins? It basically just means that you're getting rid of it. Yeah. So the supply of Luna is going to go down. Is essentially the way it works.
There's basically like an address on Ethereum you send it to, and that burns it. Does that make sense? It's like a burn function. So then like it doesn't exist because it's not in circulation anymore.
Cool, thank you. Awesome. Annamira is going to get into decentralized exchanges.
Okay, so before I get into decentralized exchanges, I just want to circle back to a couple of things that came up in what we've talked about so far. So DeFi, decentralized finance, is a whole world of protocols and services that are now existing to replace services that already exist, for the most part, in the traditional financial world. And so some things that you may have noticed that Ava was mentioning when she was talking about stablecoins was that we have this thing like a collateral-based stablecoin. That's not necessarily a new concept, because when you take out a loan, for example, you may mortgage your house. In that case, your house is being used as collateral against your loan, okay? And another example of this is, and why the DeFi space is a little bit different from the traditional financial space, is that in the traditional financial space that's being regulated by governments, not governance, we have this thing that we always rely on at the end of the day, which is this lender of last resort. If you were to take out a loan, you are signing some paperwork where you're promising to pay it back, right? If you don't pay it back, somebody might come after you and try to make you pay it back in court. They could go after your assets, et cetera. When we're working within DeFi, we're all, for the most part, we might be interacting with the protocol using some anonymous address. And so making some financial contract with another party is very, very different. And a lot of the differences that you see between traditional financial services and DeFi kind of come out of this inherent conflict where you can't really go after somebody. You can't go after their house, you can't go after their savings. You have to have some other way of ensuring that your loan gets paid back. And so when you have things come up like collateral-based stablecoins or reserve-based stablecoins, for example, I'll just keep going with the collateral example. What's happening when Ava is talking about like somebody minting DAI is they're basically kind of lending you DAI, this new DAI, but why would you ever pay it back? Like they don't have a way of making you do that unless they are incentivizing you to do so by holding some of your own assets as collateral. And so as we talk through different services in the DeFi space, keep in mind like what can you compare it to that already exists in the real financial world, and why can't we build the exact same thing using blockchain? And if we can't build the exact same thing, how do we get around that fact? So keep that in mind. Okay, so decentralized exchanges. All right, so before I click to the next slide, the way that exchanges pretty much work today, or have worked for, I guess, hundreds of years, is somebody has something, they want to sell it, so they say, I'm gonna sell it for $100. Somebody else wants to buy something. If they want to buy it for $99, they may have to negotiate with that person. If they really aren't willing to budge, no one's willing to budge, somebody's willing to buy it for $99, but there's only an available seller for $100, then those orders are not matched. No sale occurs, okay? But usually there are a lot more people willing to buy and sell, and you have exchanges like the New York Stock Exchange or the London Clearinghouse or other historical clearinghouses where people are submitting their buy and sell orders, and those orders are matched, and if there's a match, a sale happens. If you go on StubHub.com today and you look at options for like outside lands tickets or something, you will see multiple different prices listed. I just did this last week. You may see a ticket listed for 64, a ticket listed for 69, and those are all of your options. And if you're willing to buy for that price, then that order is matched. That's another example of a traditional exchange. Decentralized exchanges do this whole process in a different manner. Actually, very, very different. So there actually have been some examples of like, I think blockchain-based order book matching, but we're not going to get into those here. So decentralized exchanges. What are they for? Well, there are a lot of different cryptocurrencies out there, and people may at some point want to exchange one coin for another coin, and that's what they enable. The Coinbase example, that's a centralized version. So in that case, Coinbase is just executing their trade against some holdings that they have. Maybe they're trading with you, or they're facilitating your trade with another person who's using Coinbase. So here we have also in the slide, the classic version of an exchange is the order book, and then the other version, which we're going to get into, is called an automated market maker. You may have heard of market making before in the context of like Citadel or Jane Street or other like fancy firms. What they do is they basically facilitate this whole process, or maybe they take advantage of arbitrage opportunities by selling and buying coins at different times. So what is an AMM? An AMM that uses a liquidity pool, rather than matching somebody's desire to buy with a desire to sell, we just have a giant pool of coins that's locked up. That's called like total value locked in Uniswap. It is some number of billions of dollars. There are a bunch of tokens in a pool. So say you have token X and you have token Y. You have a pool where maybe there are 10 X tokens and 100 Y tokens. And somebody could go to that pool and say, I would like to swap some X tokens for Y tokens, and they would put some X tokens into the pool and take out Y tokens from the pool. And how many Y tokens they will be able to take out is a function of how many are already provided as liquidity to that pool. So you would expect when, say, token X, for some reason, gets really, really valuable in the world, probably a lot of people are going to want to buy that token from that pool. And so you should expect the supply of liquidity in that token to go down. And so as the value of X increases, you should expect people to go to this like Uniswap liquidity pool and say, I want X, I want X. And they start taking it out and replacing it with Y. And then the portion of X in that pool goes down. And then there's more Y in the pool. So they're providing liquidity in Y because they're saying, I would like to give you Y because I want X instead. And they're taking liquidity in X out of the pool. So what is this constant product function that is here? The way that these automated market makers work, one way that many automated market makers work is by using a constant product function where the number of X tokens in the pool and the number of Y tokens in the pool when multiplied is equal to some number K, where the total liquidity in the pool is sort of like represented by the square root of K. That's just the way it's done, and you'll see why this makes sense on the next slide. So here's an example with bananas and apples. So here, at some point on the curve, that represents some combination of how many bananas are in the pool and how many apples are in the pool. And at any point along that curve, we still have this constant product equation remaining true. So if you take some apples out of this pool and you replace them with bananas, naturally we go up along this curve, up towards like higher numbers of bananas, I guess. And if you ever wanted to figure out like how much you would have to trade in terms of apples for bananas, you would be able to solve for that price by checking, okay, well, at the end of my trade, the constant product formula must remain to be true, so I can calculate and see how many like bananas I have to put in order to get apples or something like that. And there's an example there. Any questions about this so far? I'd prefer to like do them slowly if that's okay. Anyone? Okay. So this is Uniswap, and there's something that happens with automated market makers called impermanent loss. And this is a pretty tricky concept to fully wrap your head around, but the essence of it is that if I had a bunch of ETH and I wanted to put that, like provide it as liquidity into a pool. So one thing I should have mentioned actually on the previous slide is that instead of just swapping apples for bananas in this pool, one thing that Uniswap specifically allows for you to do is for you to, instead of swapping apples and bananas, you could just decide, I would like to, instead of swapping them, I would like to just provide some apples and bananas to the pool and offer them up as liquidity. And that would make you a liquidity provider. And why would anyone ever want to do that? Well, a lot of protocols that work in similar ways to Uniswap have actually incentivized people to do that, because this automated market maker doesn't actually work unless there are tokens in that pool to trade. So they have to incentivize people to place those tokens in the pool. And the way that they do that is if you provide apples and bananas, you will in exchange get a token that represents your ownership over the pool. So you could think of it in a similar way to, like, if I buy Apple stock, I have some ownership over Apple. Not the best analogy here, because there are a lot of nuances here, which actually I might get into later if we have time to talk about securities regulation. But you get tokens that represent your share of the liquidity, and when Uniswap executes other people's trades, they take a 0.3% fee. And since you are providing liquidity to that pool, you get a piece of that fee. And so you're basically earning interest on your money. And that's not a crazy concept. We've seen that in traditional finance before, and now it's being enabled by platforms like this. Did I see a hand? No. Yes? Wait, sorry, could you say that a little louder? Yes, Coinbase has horrible fees. Probably worse fees than this, right? Yeah, yeah.
Uniswap has a 0.3% fee that it takes on all trades, and Coinbase takes 0.5% for us traders.
Yeah. Coinbase takes 0.5% in all trades, and Uniswap right now takes 0.3, so 0.3% in all trades, and I believe that that breaks down. Yeah, that breaks down further. So like, what? Yes, plus gas, right?
Yeah.
Yeah. So basically, everything on Ethereum is very expensive. Not only do you have to pay a fee to the protocol, which is necessary, because if there weren't a fee to incentivize people to, like, put liquidity in, then you wouldn't really have any tokens to swap with. But additionally, you have to pay gas prices in order to execute that contract call, because when you do a trade using Uniswap, you trade apples for bananas. What that looks like is you call the contracts that define Uniswap. So the smart contracts that get deployed on Ethereum, you basically execute some code that executes that trade for you, and the process of executing the code costs money to execute, basically. So that's what the fee is for. They have transaction fees, but if Coinbase, as a part of your transaction, has to interact with the blockchain, then you will be sort of accounting for that cost, but they're not going to call it a gas fee necessarily. I don't know. Yeah, you can jump in here.
Yeah, like essentially how it works is that on Coinbase, none of your Ethereum you don't own it, right? Like you're not able to put it into like Uniswap, you're not able to stake it as liquidity, so that ETH is just holding it as an asset. It'd be the same as like holding a stock, right? There's nothing you can do with it. You just own the stock. The difference is when it's on Uniswap, say you do that trade, now you can go take that ETH and stake it in a protocol that earns you like 8% interest on that Ethereum, right? And so to move it from Coinbase onto the blockchain, there's a gas cost associated with that. And so instead of taking that gas cost during the trade, you're taking it when you move it onto the blockchain. Does that make sense? So Coinbase charges 0.5% for all trades. That's their spread fee. And then sometimes they'll have higher rates in terms of like what the exchange rate is, because it's a centralized exchange, so it differs a little bit. Obviously, there's arbitrage there. But with the decentralized exchange, there's a 0.3% fee that goes towards LP providers, as well as just the pool in general, to incentivize the liquidity for the LPs to the pool, which are the liquidity providers. That make sense? Solid.
We'll try to save questions for the.
Yes, I will also elaborate on this later on.
Okay. All right. So the next thing I was going to mention was impermanent loss. So I mentioned the liquidity provider option of Uniswap for a reason, which is if you decide to put apples and bananas into the protocol, there could be a scenario where instead of like apples and bananas, let's just say like Ethereum and USDC. If I have Ethereum and I want to consider providing it as liquidity in order to earn essentially interest on that liquidity, I could do that. I could put it into the pool. And while it's sitting in the pool and it's locked up and I can't do anything with it, something could happen. ETH could go up really, really high in price, okay? Which is a good and a bad thing. I'll make money off of that because when I take my liquidity out of the pool, what I put in will have risen in value. However, if I had held onto the ETH and hadn't put it into the pool in the first place, I probably would have made a lot more money. And the reason why that's true with this type of decentralized exchange specifically is that if you look at this graph, or if you were to draw, actually, could you draw a circle, like a pie? So, actually, I'll draw this. So what could happen originally when I decide to put liquidity into the protocol is maybe it's like 50-50. What? I don't know what. So maybe it looks like that when I decide to provide my liquidity. So I put in like equal amounts USDC and equal amounts ETH. I put it into the protocol, and then ETH goes up really, really high in value. And what that means is people are going to start to want to trade USDC for ETH using this protocol that I just put my liquidity into. And so what happens is this pie chart gets transformed because people start asking for ETH out of this pool. Okay, so here the constant product formula is still, say it's still satisfied. And if I put enough liquidity into the pool to basically constitute 2% of the total liquidity in the pool, I have 2% ownership over the original pie, and then after ETH has gone up in price and people have traded a lot of USDC for Ethereum and taken ETH out of the pool, now the pool looks like that. I still own 2% of it, but now I own a lot more of the USDC and a lot less of the ETH. So when I take out that 2%, I'm going to end up taking out a different proportion of ETH to USDC than I did originally put in. And since ETH has gone up in price so much, it's very likely that the more it's gone up in price, the less I will have made in comparison to if I had just held onto my ETH the entire time in the first place. And that is impermanent loss. Any questions? I do want to take questions on this just because impermanent loss is like a really tough.
Make sure they know it's quantity.
Quantity? Yeah, sorry, this is quantity, not equivalent value in dollars. So since one ETH is like thousands of US dollars, you would always expect the ETH USDC pool to not be completely even because those two tokens are really not even in the real world. But yeah, okay, go for it.
So like in this example here, what Annamira is showing is the amount of USDC and the amount of ETH, right? So say, and in an imaginary world, right, where ETH is equivalent to 1 USDC, there's 1,000 USDC and 1,000 ETH in this pool. The value in the pool will always be the same on both sides because in Uniswap, you're going to have equivalent values. Like 50% of the pool, the value of the pool, 50% of it will be in USDC. So like if USDC is $1,000, you have $1,000 on this side and $1,000 on this side always. Even if there's more money in the pool now, you'll still have like 10,000 and 10,000. But your quantity of ETH, say ETH becomes $10, now you have less ETH quantity in the pool, but the value of ETH is still the same. Does that make sense, everybody? Yes? Okay, sounds good.
Okay. All right, so that's impermanent loss. Feel free to ask questions afterwards about this as well. This is just a slide that shows a couple of different automated market makers. By the way, there isn't only one way of doing an automated market making protocol. Like this is a constant product version that we just talked about where we have that graph looking the way that it did. But there's also a constant sum AMM. And then there are also more complicated ways of pricing the exchange rate between like token A and token B. One example is Curve, which is actually a hybrid of both being a constant product and a constant sum. So I wish, actually maybe I'll just draw a picture of this too, if I can. So, oh perfect, thank you. So you saw the graph for constant, this was constant product. So this is X times Y equals K. This is what constant sum is going to look like. They're going to overlap a bit here. You can see both of these have a sort of similar relationship. Like if there's, like they have this same like negative slope. but right out near the edges, there's a difference in the pricing. So like here, one is going to get really, really expensive compared to the other, whereas here it's not going to like exponentially change, I guess. What Curve does is a hybrid model where it, in some fancy way, which I don't know how to define in terms of like a function like this, it basically draws a line in between that like kind of just looks like that. And then it's like linear here, and then it starts curving again. They just do this weird hybrid model. So
It curves.
yeah, it curves. I guess that's why it's called curve. But yeah, so there are a lot of different ways that you could define a decentralized exchange. Just because these are the ways that they have been built so far doesn't mean that you couldn't go out and come up with an entirely different pricing mechanism. So just keep that open, because DeFi, all of this stuff is just a couple of years old. You could come up with something totally different. Huh?
I heard of a cool way to tackle impermanent loss the other day.
Okay.
Have you heard of it before?
You should. Oh yeah. Well, I guess one of these algorithms supposedly tackles impermanent loss, Bancor, which, as far as I know, is like similar to Uniswap, but has some small changes. And then Balancer allows you to create pools with up to 8 different tokens at once, as opposed to just 2. So that's interesting. But I'll just move on in the sake of time. Questions at the end of this section? We covered some in the middle, so hopefully not too many. Okay, I'll move on. Okay, so yeah.
Go back to questions really quickly.
Oh, wrong computer.
This was what we went over. If you want to like just look at it, let it absorb into your body.
Yeah. Yeah, this is supply and demand right here. That's all that is. So traditional economics applied to DeFi. This is just what a liquidity pool looks like. How much people want to provide of one asset versus another.
This is the foundation of decentralized exchanges. So if you get this, like
Yeah.
you got that section.
Yeah. And one thing that happens to me is like I sometimes get stressed about how many different decentralized exchanges there are to understand, because each one has some slightly different approach to pricing. I think the most valuable thing to do is to just understand the basic example of how Uniswap works. And then if you are really curious about DEXs specifically, then you can go in and read the white papers of how all of these weird algorithms work. But Uniswap is kind of like the core basic example to focus on. Alrighty. Yeah?
So as like more, I guess, DEXs come into existence, and I guess like this liquidity pool kind of get balanced out as far as like people wanting to provide liquidity for
Yeah.
interest or to earn something.
Yeah. So people will provide liquidity to earn interest. And one thing you're mentioning is like, as a lot of different exchanges come up, there's a possibility for arbitrage. So if for some reason Uniswap has a different price in its USDC ETH pool than like Balancer has, then somebody might go in and sell in one pool and buy in another and make money off of that. So that's called arbitrage. And the more exchanges exist and the more liquidity there is provided for people to trade with, you should expect the prices to get more and more accurate. And that's what has already happened, because the traditional financial world is very, very well arbitraged. Like, you won't see giant exchange rate discrepancies from like one currency to another. But in the DeFi world, since it's not as saturated yet, there are a lot more arbitrage opportunities that still exist. And so people will build bots to go out there and like take out loans using the lending protocols that we are about to talk about. And then they'll lend tokens and then use it to find arbitrage opportunities between different decentralized exchanges and then trade on that. So, yeah. Okay, lending markets. So this is another traditional financial service that's being transformed into being hosted on a decentralized platform. So usually you would go to a bank. Okay, usually you might go to a bank. You might go to a bank and lend money from the bank in exchange and maybe mortgage your house. You might go to some black market lender, and then you might be paying much higher interest. There are a lot of different ways that people lend money, borrow money. Another way is you could lend small amounts of money by buying bonds in our traditional markets today, and all of these things are being replaced by decentralized protocols. So yes, the purpose is a way to get interest. If I have tokens and I want to be a lender, then I could lock up my tokens and lend them out to other people in exchange for interest. And the reasoning for why this is important is that in the US, we trust our financial systems a lot. If I take out a loan, usually they expect me to pay it back. Sometimes that crashes and burns, as we saw in the 2008 financial crisis, where people were getting a lot of really, really risky loans for houses that actually had very high risk of default. And then those debt instruments were then wrapped up and resold in ways that hid how risky they were. And then we saw that financial crisis blow up. And so even in where we are currently living in the US, we can't always completely trust our financial systems to work. We see banks fail. And then if you go to another place like Venezuela or Zimbabwe that have experienced extreme inflation, those financial systems are even less trustable, usually. And so the reasoning, a big motivator for these types of protocols is that this is a very trustless way of transacting and creating contracts with people. Contracts are only enforceable if you have someone to enforce them. What happens in DeFi is like you build a contract on the protocol and it's automatically enforced. So some top lending and borrowing platforms are Aave, Maker, and Compound. Aave already mentioned how some of this works. Usually what happens is instead of mortgaging your house, you have some token and you give it to the protocol as collateral. If it's a really, really risky or volatile token, you might have to put up a lot of that token as collateral in order to exchange a less risky token. If it's the other way around and you have a really stable token, you might only have to put up like, some of it in order to borrow a really risky token. So depending on how volatile the different assets are, there may be a different requirement for how much collateral you put up in order to lend that token, borrow that token, I mean. And Aave and Maker and Compound are all different ways of doing that. All of them require collateral. And how does this work? So when you lend a token, you will get some interest. And how much interest you get is usually a function, depending on how the protocol implements it, it's usually a function of how much supply there is of lenders for that token at the moment. So for example, if everyone for some reason really, really, really wants to borrow DAI, you would expect those borrowers to have to pay high interest. And so I might, as somebody who owns DAI, I might really like to lend DAI at that point because I know I'm gonna get high interest. And that's the way that interest rates work in the real world. If a lot of people wanna borrow money, the economy's really hot, they're probably gonna have to pay higher interest because there's a lot of demand for that loan. And so that same relationship between interest rates and demand for different tokens is captured by the way that these protocols are implemented on-chain. Okay, this is a shorter section to explain, I feel like. Yeah, I have to go faster, okay. Okay, I'll go on. Okay, derivatives, another financial, another traditional financial asset that is being transformed on the blockchain. So if you don't know what a derivative is basically a contract to either buy or sell an asset at a given date. And that's the simplest version of it. It may be an even more complicated derivative, like a option or a put, like call or put option, where not only do you have an you don't actually have an obligation to buy at a certain date, you have the option that you could decide between one of two different things. So you could either buy it before that date or not. And you'd be paying a price just to have that option. So derivatives are a way of making it like easy for people to take bets on what they think is gonna happen in the future. Another example is literally just a futures contract, which is somebody agreeing to buy corn in the future at a certain price because they're trying to they're just betting on the price of corn basically. And the way that derivatives are currently being created on the blockchain is by, okay, there are a couple of different versions I'm going to talk about. One example is UMA, which basically uses staked collateral. So people stake some collateral and then they get a tradable token And then those tokens either will trade above or below their collateral value. And since it's a derivative and we need to have some like time limit on when that option, for example, expires, what happens is they lock up their collateral. I say like, okay, I want to lock up some ETH, and then I get a token that represents that ETH until a certain point in time, at which point that token is redeemable for ETH. And so in that time window before the like contract expiry date has been reached, that token could then be traded on the market for whatever its current value is, in a very similar way to how a derivative option may be traded on the market. And then that could be traded up until the point when that option expires, at which point they would just get that ETH back. And that's another way that people can just bet on the price of, the future price of ETH. So like, for example, if I were to buy that token, I might be betting that the price of that underlying ETH is actually going to be really high by the time it expires, which is why I want to have the right to own that ETH when it's redeemable in the future. So that's an example of how that works. There are a couple of other examples of how derivatives on chain could work that I won't get into, but if you have questions later, we can get into it, because I'm taking a lot of time. Yeah, so synthetics is one, DYDX is one, UMA, this is the red one that I just explained. And now it's back to Ratan. Actually, questions? Derivatives? I can go over one other example of how derivatives have worked in blockchain if you want, but yes? Okay, so one other example is BitMEX, which had a way of, basically came up with this like perpetual derivative that doesn't have an expiry date, where people basically, they take either a long or short position and then are obligated to either pay every 8 hours towards the people who hold the opposite position, or they get paid by the short sellers in the other direction every 8 hours. So depending on, so they would take a position, like the position is ETH is worth $100. If I take a long position on that asset, that means that if it goes above $100, the people who paid into the short position would pay me, and if ETH then went below $100, the people who took the long position would pay the short sellers, or the short buyers, I guess. So that's one example, but BitMEX also has been shut down, right? BitMEX had some issues with the SEC. And this actually happens a lot. So DeFi, since it's replacing traditional financial protocols and tokens, sometimes they look a lot like securities, and right now, the SEC has actually hired a new chairman, Gary Gensler. I forget exactly when he went into office, but he was partially hired because he has a lot of knowledge about the crypto space. And so we're going to see more things come up soon, where different protocols and companies are being sued because they're not following laws, or they aren't being properly taxed the same way that securities and capital gains would normally be taxed. And so there's a couple of legal tests that are used to determine whether or not something's a security, like the Howey test, which is really cool if you want to Google it. But yeah, so the legal landscape is changing as these protocols gain more and more value. And the main reason is that, one, the government would like to tax the money that people are putting into these protocols, and two, that it's being used to launder money in some cases, and the government would also like that to not happen. Yeah.
Question for lending platforms. When you lend somebody, let's say 2 Ethereum, do you lend the quantity or the value of them to others? Like, do I lend them $200 or do I lend them 2 Ethereum?
So people are taking out loans in the terms of tokens, but the way that the ratios of the collateral, like how much collateral of another token they have to put up is set, is decided by using the equivalent USD price. So the answer to your question is kind of yes, kind of no. They're lending out the token themselves, but how the collateralization factor and how risky that loan is determined based on how much that token's price fluctuates in terms of dollars.
But if I lend 2 Ethereum,
Go for it.
I can always get 2 Ethereum back.
Yes.
So if I'm interested in generating interest rates, why wouldn't I do that over the first option you mentioned? Like, I can't see any advantages of doing this over here over this second one, because you can just.
Yeah, so they're a bit different. So in this one here, this example, you're talking about supplying liquidity to these pools, right, and getting liquidity tokens for it.
But
So
the reason why
Yes, the reason why you supply liquidity is to earn interest. So those interest rates, though, they're not necessarily set. So say there's a new protocol, they just launched their token. That token is giving you an equivalent interest rate of 15%. Typically on Aave for Ethereum, you'll get around the range of 2 to 3%. Same with Compound. So it's not really, it's like it really is dependent on the protocol and how it's engineered, right? Some protocols are more stable, some are more volatile. And so it's really providing a broad range of opportunities for investors. Like that's essentially what it's doing, right? Like there's never gonna be one thing that's always better or another thing that's always worse. It's more dependent on, okay, do I want stable 2% or do I want a risky 15% or a risky 50%? So that's kind of where that falls. Solid? All right, go ahead.
It's the same Ethereum network if you're in the US or another country, so government starts to tax if they want people to go to countries.
Oh, like leave the country? Yeah, like, so we'll run into this later. I'll talk about this a little bit later too, but essentially the reason why people get regulated is because they don't do it the right way. They'll either say, hey, my protocol is a security. They'll be like, okay, if you buy us, it's equivalent to our company doing better, which is a security. If you're not registered with the SEC, they can prosecute you for that. And so what some people will do is instead of diving into like regulatory issues, they'll just go and work in like the Seychelles and just not come back. And because you can launch it from anywhere and people can use it from anywhere, it's available in that way. But like for DYDX, for example, derivative products by crypto companies for the most part are not allowed in the US. And so it's available in like the UK and France, but you can't trade those. Like you can't, if you go to the DYDX website, you can't trade certain options on there. Like I'll say this is US, restricted for US residents. So yeah. All right, solid. I'll go ahead and dive into the last section of the pillars of DeFi, which is asset management. So asset management, essentially what it is say you have a bunch of different assets. What I want to do with them is I want to put them in a place where I can see, hey, this is how much my assets are worth. Here's the assets that I have. And I don't want to have to go to each and every one of these individual protocols and put my money here, put my money there, right? I want to be able to invest in Compound. I want to be able to invest in Aave. I want to be able to trade in Uniswap in one centralized interface. Asset management protocols enable you to do that. And so there are different platforms in DeFi that essentially enable you to access all these different range of options that DeFi provides you. They're automated, they're globally accessible, they're anonymous. They take all the advantages of blockchain and plug them into an interface where it makes it easier to understand what assets you have in DeFi and use protocols from one single interface rather than other ones. So there's a couple of cool ones, Set Protocol, Zapper, and Zerion. Set Protocol is really interesting because it gives you access to a basket of tokens. So essentially what that means is instead of having to go out and trade for 15 different assets on Uniswap, you can instead buy a basket of tokens on Set. The common one is called the DeFi Pulse Index. That's a lot of one that people use. Essentially gives you access to like a basket of tokens. Is anyone here not familiar with what a basket of tokens is? Okay, so a basket of tokens, essentially what that is that it's a bunch of different tokens. So you took a bunch of different stocks and put them all together. So it's like trading like an index of that thing. So it's like an index fund, right? So you'd have like 20% Apple, 20% Facebook, 20% Google, and track the overall price of those stocks. In the same way, the DeFi Pulse Index tracks the overall prices of the top DeFi protocols, and that's essentially what it does for the Set protocol. So not only do they have the DeFi Pulse Index, but you can create sets, you can have sets. That's what the advantage is. And so that's a really cool protocol as well. Zapper and Zerion are more of dashboards. You put your Ethereum address in, you log in with your MetaMask, your Ledger, whatever, like to get access to those protocols, and then you can see a dashboard of all your finances. So those are really cool. Would highly recommend checking them out if you're a high-powered DeFi user. I personally use Zerion, but Zapper's pretty good too. So yeah. Any questions? Okay, solid. Now we're going to dive into how DeFi started. I hope you guys did enjoy the section about the fundamentals of DeFi, but for me at least, what's always really fun to talk about is why and how did this all start? What caused all the hype around it? What made people so interested in it? And that really comes back to DeFi Summer. So DeFi Summer is the colloquial name for the summer of 2020, when DeFi really went off on this rocket ship, right? It was $500 million in total value locked. Now it's $100 billion. Obviously, how do we get there? Right, that's the question we need to ask. And so it really all started out back with the MakerDAO hack. MakerDAO was touched on earlier. That is the home of DAI. That is where you mint your DAI for Ethereum. But essentially what happened is that the MakerDAO hack caused Maker Protocol to get hacked and really demonstrated this kind of loss of trust in DeFi. People didn't want to put their money into DeFi because if I put my money in, what's the guarantee that I'll get it out? When people don't have trust, what's my incentive? that's what this hack really put into question, right? And so as you can see here, the total value locked in Maker dropped off a cliff. And when Maker drops off a cliff back in the old days of DeFi, that means DeFi is nearly dead. And when DeFi is nearly dead, well, that means no more DeFi. So the new question was, how do we ensure that people are incentivized to use these protocols? What is the incentive of, as you said, minting ETH for DAI? Like, why am I doing that? You know, I'm not earning that much money on it. The reason why I'm doing it, like those reasons, those incentives aren't there. And so how do we incentivize people to put their money in, to use these protocols and leverage them in the way that we want them to? And that really all started out with Balancer liquidity mining. So Balancer was touched on a little bit earlier. Balancer is a kind of AMM. It's like you can create a bunch of different markets, but essentially what they did is this really cool chart down here. This was the start of liquidity providing, right? And so there was this new concept of, before, people really weren't putting money into these protocols, right? There wasn't an incentive. You weren't getting a token for lending out your money on these protocols. You were getting like a 2% interest rate on top of that, right? And so 2% as compared to banks really isn't that much. You can go in and 2% in the stock market anytime you want to, essentially, right? Like the S&P 500 earns 8% a year. And so people need an additional incentive to be using DeFi, and that's where liquidity mining comes in. And so users, for supplying liquidity, would now be given governance tokens to do so. You might be asking, what are governance tokens? Governance tokens give you a stake in the protocol. As Annamira said earlier, if you have an Apple share, you don't necessarily have a vote in Apple, right? Like, where are you going to vote for that share? Like, no one, you can't go to an Apple meeting and be like, hey, I'm going to vote on this. But with governance tokens, you can do that. You're given a stake in the protocol via a token that has an intrinsic value. So when Balancer launched, back in the day, back before like everything was set up, essentially you would supply liquidity on Balancer, and they would post this Excel sheet of like all the Balancer token allocations for Ethereum addresses. So they'd have like 700 Ethereum addresses of all the liquidity providers, and then they would have the associated Balancer that you had earned that week, and then that would be airdropped to your address. Now it's done block by block, but back then that's how it was done. And so what that meant is that by, say, supplying $10,000 in liquidity, you were given 50 Balancer tokens per week. 50 Balancer tokens at that time was worth $1,600. So for supplying $10,000 into Balancer, you were earning 16% a week. 16%, not a year, a week, which is ridiculous, right? Like, that is insane in terms of APR. And so people were now directly incentivized to use these protocols. So what you see is that the liquidity in these protocols went through the roof. Because as soon as people saw that you could earn that much money, well, why would I not dump my money in? I personally dumped a lot of money in that. It was a great time, would highly recommend. But that's essentially how that happened, that kicked off. And so now that Balancer started doing it, other protocols were like, why are we not doing it too? And so Compound is one of the biggest protocols in DeFi. They decided to launch a governance token. So instead of just being able to sell this token, what if you were able to use this token to make the protocol better? And so what they did is that they launched the Compound Governance Token, COMP. And what that means is that now, instead of just being able to sell the token for providing liquidity, you could vote on the protocol. So there's a protocol interface for you to vote on proposals that could then shape the future of Compound. Say you wanted to vote on changing the collateral factor that was required for the ETH market. Now your one vote would go towards being able to do that. Previously, decisions that were made by the protocol teams were now being made by the community. People who held the tokens were now being given the opportunity to change those platforms. And that was really something that was groundbreaking, right? Now it's not just the protocol teams that are changing it, it's the community. And that's what the advantage was. And so this really demonstrated a really interesting part of DeFi, because now you're seeing this transition of the product being good to the community being involved. When the community gets involved, that's where you see the opportunity for explosive growth. And so now we look into Urine Finance. So the Compound team had launched Compound back in like 2018. And it was like a very typical team. You know, you have like your like VC backing, everything like very typical of like normal startups. Where the spirit of DeFi comes from is from Andre Cronje. So Andre Cronje is an OG crypto dev. Essentially what he did is that he created a protocol called Urine Finance, which enables you to earn yield off of tokens, and just launched it. He just put it out there. He decided to post on Twitter one day, hey guys, release this product. And as you can see here, it just blew up through the roof. So it launched back in July, and its token went from 0 to like 36K. There was like 1 million tokens. It was like ridiculous, right? Like, or not 1 million tokens, like 10,000 tokens. I got those numbers wrong. But like, yeah, like essentially like the volume on Urine Finance and the market cap of Urine went up to about $1 billion within 2 months. So imagine you're just like this random anonymous person, or not really anonymous, but this random person decides one day, hey guys, I have this really cool idea, launches it on Twitter, and now your token's worth $36,000. That's essentially what the spirit of DeFi is that anyone with a good idea is able to launch these kinds of protocols and cause this to happen. And so that's really what Yearn Finance represented. And it represented that you didn't necessarily need a startup team, but you could also be using just your developer skills to put out these interesting and amazing ideas that could transform what the future of DeFi would look like. Yeah. And now you might be asking, so I talked about YAM earlier. So if Andre Cronje is able to put out a protocol, that means that also anyone can put out a protocol. But if no one is vetting these protocols beforehand, how do you know the protocols are safe? How do you know there's no exploits in them? Well, that was really tested here with YAM Finance. Someone decided to launch a token with a YAM as the head of it. It blew up to about $70 million in total value locked, and in 2 days, dropped back to zero. So launch, first day $63 million, and next day $0. There was an exploit. Someone was able to take out all the money from the protocol, and it again demonstrated that even if the returns are high, you need to make sure that whenever you invest in a protocol, that it's audited. Audited protocols means that there's no exploits that can take away the money of the protocol, because the only people that have anything to lose are the developers and the people in the community who put their money into the protocol. Say you put $10,000 in here, it's gone. Nothing you can get back, just because someone decided to exploit the protocol. And so in DeFi, this really represented a turning point, because not only was this covered within the crypto community, but the overall community, right? You know, if a regional bank just decided to one day take up and take everyone's money and there's no way to get it back, people will be scared, people will be concerned. That's what YAM Finance demonstrated. It demonstrated that even if it gets traction, that traction is worth nothing if their protocol itself isn't safe. And this really demonstrated a turning point in DeFi, because it showed, once again, that without the proper auditing, bad things can happen. And when bad things happen, people don't want to put their money in. And so, yeah, not very ideal. So after YAM, there was kind of this downtick in interest, right? People were like, why should we be putting our money into DeFi if we don't know DeFi is safe? The last breath of DeFi summer came from the uni drop. And so this was really something where it, I think, revolutionized the way that we think about community. So with Compound, you had to be pretty big to earn Compound tokens. In terms of pretty big, I mean putting in like $10,000, $100,000 to earn any like relevant amount of Compound. You had to be putting a lot of money into these lending protocols. What Uniswap did is that anyone who had used Uniswap, didn't matter if you had put in $1, didn't matter if you put $10, didn't matter if you put $1 million, would receive 400 Uniswap tokens as a part of their community launch initiative. So when they launched their token, every single person who had used Uniswap, had traded on Uniswap, had gone to one of these pools and put some money in, got 400 Uniswap tokens. You might be asking, what was the price of Uniswap when that happened? $4. So even if you had only done $10 in trading on Uniswap, you now just got $1,600 dropped to your wallet because you used it. And so this really signaled the beginning of generating community, but then as a result of that, if everyone is given $1,600 free dollars, who's not gonna sell those tokens, right? If I'm just giving that kind of money, I'm telling you, as soon as I got that token, I sold half of it, because I was like, there's no way that I'm not gonna let myself get $1,000 right here. So I sold that token, and as you can see, a lot of people had a very similar idea to what I had. And so even though they had generated community, would it stay? Would it stick even with that token generation? And it didn't, at least for the 3 months following the token drop. And this really signaled the end of DeFi summer, right? Because it showed even if you give people free money, they weren't staying, which means that there needs to be innovation, because if there isn't innovation, then people are just gonna dump. And so DeFi summer really demonstrated what can happen when you have a sandbox, when you have this ability to generate new protocols, new things, and really transform the space. But it also demonstrated that if you don't do it correctly, people get hurt. And people aren't necessarily given the incentive to stay unless you give them that incentive. It's really this idea that if you have a great idea and that idea has sticking power, then it will stick. But if you don't, it's not guaranteed. So yeah, that's basically how DeFi started. And now we'll be diving into a little bit more about where that comes from. Before I hop off here, any questions about DeFi summer? Okay, let's go. Now we'll be taking a look at what DeFi is today, right? So that was how DeFi started. Now let's take a look at what DeFi has been in the past, or DeFi is in the future. So DeFi represents so much, right? It represents everything from yield generation to trading to exchanging. And where does that all begin, right? Like, what does that look like today, and what are we looking at? So as you can see here, this is a map from about 3 months ago of what the DeFi space is. There's a lot of things on here that I cannot name, and I don't expect you to be able to name all of them, but a lot of the really cool ones are on here. Maker, Aave, Compound are down here, as well as like Chainlink, Uniswap, all the big names. So there's a lot of great protocols that are out there, and the entire space continues to innovate at a rate that is just incredible, right? Like you have new projects coming out every single day, getting incredible amounts of volume. The auditing today is a bit better than it was back in August of 2020, but it's still very fast moving. And when it is fast moving, people do get hurt, but there's also the advantage that there's a lot of innovation that's happening. And as long as that innovation is happening in a good way, it's a good thing. So everything from DeFi really comes back to this concept of community generation, right? The biggest difference between centralized systems and decentralized systems is the fact that when you're in a centralized system, you don't have a say. Governance has given every single person who's in DeFi a say over what DeFi looks like. And so on Compound, that means that you're able to vote on Compound with, we as Blockchain at Berkeley have over 2 million votes on Compound, so we're constantly looking to update those and change those for the future. But there's thousands of people voting on these protocols. In traditional places, you have like boards who are voting on the ways that like the protocol move forward in the future, but on the last Compound vote, there was like over 2,000 people who voted on this protocol change. So it's pretty incredible to see everything. And even beyond that, it's not just the people who own the tokens, it's the people building on it. And so within Web3 and within the blockchain space overall, there's thousands and thousands of developers who are continually ideating and innovating in the space. And the barrier to entry, and this is one of the big things, is the barrier to entry to become a good developer in blockchain and actually build something is significantly lower than it is in the traditional space. You have people who are like 15, 16 coming out of high school building insane things that get like tens of millions of dollars in total value locked. And these protocols that are now like at the face of DeFi, but when you're in the traditional space or like you're building things as like in like a startup or in like traditional places that are not crypto, it's a lot more difficult to get that kind of traction. And as a result of the fact that it's now person to person as a part of blockchain, you're able to generate things and ideate at a much faster level, which makes it really interesting because now anyone who has a great idea can put it out there, no matter what your background is, as long as you put in the time and the effort to do so. And that's really something that sticks out to me and has made me really interested in the space as well. So, yeah. Any questions?
Yeah, I just had a question. Who comes up with the proposals
For the governance? The entire community. So like if you have tokens on the platform, you can propose a proposal. So like we've put up proposals on platforms. There's plenty of people across the space who are doing the same thing too. And so really the big advantage is you don't need to have a massive say to make your voice outspoken. If you have a great idea that you can put it out there, it's the same level playing field for everybody. And that's what the advantage is. Any other questions? Go ahead.
I think you mentioned the fact that you have ownership of the token allows you to sort of provide your input or whatever.
Mm-hmm.
Does the amount of ownership have any correlation with how much your input is valued or how voted?
So yeah, there's multiple systems for governance, but the most common one is token-based governance. So one token corresponds to one vote.
Okay.
So if you hold one Compound, you have one vote. If you hold 10,000 Compound, you have 10,000 votes. Okay, solid. Last section, here we go. Now we're gonna be talking about the future of DeFi. So now that you guys have seen everything from the pillars to how it started to what it's looking like overall in the current space, where do we go from here? So in the past few months alone, we've seen that there's been some incredible movements in the space. Obviously, I wanted to include as many of these as I could, but I did not have the space on the slide to do so. So taking a look over the past couple months, we've seen some incredible projects being deployed across multiple L2s and cross-chain. L2s are essentially a more scalable version of L1s. They're built on top of like your Ethereums, your Solanas. That's essentially what they do. And so like things like Polygon and Avalanche have been taking on new platforms, such as like Aave and Compound have migrated onto at least Aave has moved on to Avalanche, and there's a lot of other projects being deployed across these chains. So what that means is that those typical things that you see in DeFi where, say, like you have to pay $50 in gas fees to do a transaction on Uniswap, those rates are a lot lower on L2s because they make the fees lower. And so it's been really cool to see how more people have been able to get involved as a result of these projects being deployed across chains. Do you have time for that? Yeah, like L1s, we can talk about that later, yeah. But yeah, and on top of that, we've seen that algorithmic stablecoins such as Fei and other stablecoins have really been taking over. So obviously DAI was the original stablecoin, but since then, or one of the original stablecoins, but since then we've seen that the rise of other stablecoins that have different innovations have been able to advance in the space as well. Beyond that, the inclusion of EIP 1559, which makes ETH a deflationary currency, and this idea of ultrasound money was also included. We've seen the rise of DeFi 2.0 with ownership within protocols being tested. As we said earlier, and you touched on earlier, 1 token equals 1 vote. That means if you're a small token holder, you don't necessarily have as much say in the protocol as you should. What's your incentive as one person who holds 1 token to participate in the community as much as someone who holds 10,000? And so with DeFi 2.0, we're talking about how do we incentivize people to get more involved in DeFi and in governance as well. And so that idea of community generation, developer generation, idea generation, that's what's been happening in DeFi 2.0. Beyond that, we've seen that the idea of structured yield products and yield aggregators has really pushed the bounds forward on what it means to earn interest. Aggregating all these different interest sources and figuring out which ones are best, you want a central interface to do that, right? Like say, instead of having to look on every single protocol and seeing what the best rate is on Compound, Uniswap, or Aave, you could go to one platform and say, hey, just give me the best interest rate possible with this risk tolerance. That's the new inventions that are happening in the space, and that's what really makes it really cool. On top of that, last summer, it was a lot of crypto native people in DeFi. Now institutions, everything from the Fed Reserve to international banks in France and Canada, as well as things like Fireblocks, which is like a institutional custody provider, are coming onto DeFi. And so a lot of this big money that previously was in the space is flowing in. And when big money flows in, you see that the bounds of what DeFi is able to accomplish are tested, but then adoption is also good because it puts DeFi in front of the eyes of more people, and it puts these ideas of the fact that DeFi is more efficient, it's more effective at what it does, and it's more resistant to change, and is obviously corruption resistant as well, is being able to be put in places where there are issues. We had talked about decentralization of current financial systems. Institutions coming into DeFi enables that to be decentralized. On top of that, the rise of NFTs and NFTFi has been really cool. Everything from fractionalized NFTs to a bunch of other topics that we can touch on later. If you have questions, you can ask me about after class, has been really cool as well. So even though DeFi is past its initial burst, there's still a lot of growth and innovation to happen, and we're looking forward to that. So some trends to watch for. Aggregation obviously is really big. You can now go on to things like 1inch, which is a DEX aggregator. So then you can see the rates. Is Uniswap the best rate? Is SushiSwap the best rate? Is Bancor the best rate? Is Balancer the best rate? You just put it in there, it finds the best trade for you possible. That's essentially what those are doing. And so they're really cool on that side. Beyond that, we have things like privacy. This is, again, a really big topic, so I'm just giving you a very quick overview here. There's been a lot of strides on making these things a lot more private and a lot more anonymous for people that are using them. With privacy comes the ability to make these systems more secure, and security is an important part of why we use blockchain in the first place. And so we're seeing advents of technologies like ZK Sync, which is becoming more mainstream, Snarks and Starks. Starkware is actually a company founded by a Berkeley professor that's been really big, Alessandro Chiesa as well, so that's been really cool to see on that side. Beyond that, we have things like decentralized governance. Annamira touched on this earlier, but that has been very active when it comes to what governance looks like, and we're seeing that more and more people are getting involved in governance from day to day, which has been really amazing to see. On top of that, we talk about scalability. So Ethereum 2.0 is right now, I believe, predicted to release in December. EIP 1559 got passed, but DeFi is not all of Ethereum. When we talk about Ethereum, that doesn't mean that we're just talking about DeFi. We talk about everything from DAOs to NFTs. That's what Ethereum 2.0 impacts, but there's a lot of interesting things that are happening just beyond Ethereum, which weren't happening about a year ago. Everything from Avalanche to Polygon has really been fascinating to look at. And with L2s, things like rollups and Optimism and Arbitrum, there'll be a lot of great things happening. So it's going to be very exciting to look for. And
next week, we go over scalability.
Oh, awesome. So you guys will learn more about this next week as well. It's a very deep topic, so I'm not giving the overview that it should have.
But L1, L2, we're going to cover all that.
Yeah, so look forward to that. So the last thing that I'll say today is that DeFi is really something that has been a bit unbounded, right? It's obviously been a sandbox. We talk about what does DeFi mean, who does it help? It helps everyone from people who are unbanked to institutions, and it's really transforming this idea of what financial institutions are from the ground up. People who previously didn't have access to financial tools are now able to do things that they were previously unable to do because of what DeFi is. But then with that comes making sure that we balance who DeFi is for in the future. And so when we talk about what DeFi is to people, there are different ways to incentivize interest in DeFi, and that comes down to what the decisions are made at the protocol level. And so governance of DeFi by the communities will be vital towards seeing what DeFi will be in the future and who will it be for. But yeah, that was a lot. But thank you guys so much for staying. I really appreciate that. And if you guys have any questions, now it's time to ask. Thank you, everybody.
Thank you, guys. Okay, thank you for sitting through that very long lecture. I hope you learned something. As a treat, I said I have a surprise. So today we are very lucky because one of the, like I touched on up here with UST and Luna, I touched on the Terra ecosystem, the Terra blockchain. The lead architect for one of the protocols on Terra called Anchor, which is a lending borrowing protocol, you may have heard of it, is here with us today. So Ryan, if you'd like to come up. He's visiting, they're based in Korea, so he spends most of his time in Seoul, but he came out to the US for the Mainnet conference in New York City, and he's been in SF for the past week. I asked him to come out. He said yes. So if you have questions, I know there were a lot of questions about algorithmic stablecoins. Anchor is lending borrowing. He literally built it. So if you have questions on lending protocols, you will not get a chance like this again to talk to someone who has actually touched the code itself and has been able to have like a really huge influence on an ecosystem like that. I'm sure he can also speak to other questions you have about Terra, their governance, the way that their ecosystem works. It's their own blockchain. So give a big round of applause for Ryan. Sorry to be on the spot.
Yeah, just wanted to drop by, so I'm here. Yeah, I had a bit too much coffee today, so I'm shaking my hands. But yeah, if there's any questions regarding like algorithmic stablecoins, most notably UST or Terra USD, or any questions in DeFi in general, because I've been in the space for quite some time. Yeah, go ahead. What is your definition of fun? Okay, like what are you interested in?
I just want to hear more about it.
Like what differentiates Terra as a blockchain, maybe? 3 things.
Let's see. I guess like, first of all, it's Cosmos based. So it's based on Cosmos SDK. I believe Sunny, who was like one of the members of Cosmos, was also from Berkeley as well. So it's Cosmos-based. Unlike other Cosmos-like chains, it has its own smart contracting layer called Cosmosm, which is different from Ethereum's EVM. And lastly, it's natively implements an algorithmic stablecoin. So unlike USDT or USDC, which is backed by fiat money or something related to that, its stablecoin manages its peg with the US dollar by algorithmically adjusting supply and demand. Well, that's actually quite a difficult concept, so if you could specify your questions a bit more, I think it'll be more helpful. Oh, please go ahead.
Is it tied to another coin? Like there's something about how one coin would be inflated, the other one would be burned.
We went into a little bit the algorithmic relationship if you want to get into it more.
Oh, yeah, sure. So the key point of algorithmic stablecoins in Terra is like we natively assume that the demand for our stablecoin would be variable upon adoption. So if there's a lot of adoption going on, there'll be a lot of demand. And by the laws of supply and demand, if the supply stays the same, but if demand goes up, the price of UST, our stablecoin, would also go up. The key mechanism for retaining the peg in those cases is to increase supply so that it matches increased demand. And how it does is, yeah, let's say like UST is now trading at $2 on secondary markets, basically cryptocurrency exchanges. But on top of the Terra blockchain, you're always able to swap. So you can burn 1 UST and you can mint $1 US worth of Luna. And vice versa. If you burn $1 US worth of Luna, you're able to mint 1 UST. So you're basically able to swap, do like a value exchange between 1 UST and 1 USD on top of the Terra blockchain. So any price differentiations on secondary crypto exchanges that will lead to arbitrage opportunities between the primary market, the Terra blockchain, the mechanism here, and the crypto exchange. So that would revert the peg back to one-to-one. Oh, yeah.
What happens in the case if there's like an extreme lack of demand on like both stablecoin and the coin it's correlated to, or if there's like extreme demand for both of them?
So if there's extreme demand for both of them, that is not actually too much of a problem, because this arbitrage works as long as Luna has a non-zero value.
Did you say lack of demand or demand?
Lack or just extreme? Both cases.
Both extremes.
Yeah, so for the latter, like it's not really a problem, because if Luna has a non-zero value, then this arbitrage mechanism that I just mentioned can go on. If there is no demand for Luna, then there isn't much of a solution. But yeah, but that's applicable for pretty much any asset in the world. Like if no one's buying it, if everyone's selling it, no mechanism will work and no finance will work. Oh, yep. I would say so. There is a risk. There has to be more market adoption and stable demand, not just from the mechanism itself, but from real users. So other risks will be the mechanism itself failing or demand fluctuating way too frequently and on like an extreme scale. But I would say those are things that are quite of low probability. It's very rare, and you probably won't expect that to happen. Sure. Oh, sorry, can you repeat?
What would happen to your money if it did DeFi?
Your money will depreciate in value. Because, like, let's say you hold 1,000 UST, but if UST is trading at 50 cents, then the value, the US dollar denominated value, would be 500 US dollars. Well, action is the mechanism here would create arbitrage opportunities. So because you can now, let's say USD is now at like 50 cents, because you can acquire USD at a discount compared to like the mechanism in the primary market. You can buy USD, people can buy USD and then burn them in the primary market to create profits. And every buy on secondary markets just increases the price and vice versa.
I think also like an important point is that the reason it works is that when you go to the Terra station, so with the native wallet, you can always trade for one UST, right? So that's why when you say primary or secondary, you're referring to Terra wallet in this case, KuCoin or any other exchange.
Yeah, that's right. So primary will be accessible from Terra wallets. You're interacting with the chain directly. Secondary will be like cryptocurrency exchanges, KuCoin, I don't know, what else? Yeah. Yep.
Is the primary use just for store of wealth, or do people actually use it in transactions? Because one thing that I've kind of like looked into more is just their short-term capital gains tax, even on stable coins, which kind of make it hard to just use on a day-to-day basis.
Yeah, so for that, I think a lot of stablecoins that have been newly created focus more on the speculation side and the store of value side. But my opinion is that there should be more utility and there should be more adoption for real usage. So the concept is if you can actually utilize your stablecoin on, I don't know, there's like a variety of yield opportunities on DeFi. If that actually becomes a thing amongst the general public, then there is no reason for you to cash out, let's say UST, like every time you make a profit. Because you know for a fact that you can cash out anytime in the future. There's no reason to do it right now. And if that trend persists, then a lot of real transactions will be happening based on the USD stablecoin or any other stablecoin. And I believe that's like the thesis for pretty much any other stablecoin out there.
But if I were to like buy like shampoo with
So the capital gain tax is like if you bought one USD, if you bought some token for $1, and if you sell it for $1, you have made zero profits. So yeah, so you won't be paying much tax.
I've been using like USDC on Coinbase, actually on card or whatever, and so they pay me like a percent of interest whenever I pay in USDC. I get like 4% back or something like that.
And then you never really sell your USDC. So I think that my understanding of how the tax would work is if you ever did sell that token back for normal USD, put it in your bank account, then the tax would apply. If you were somehow able to directly exchange it, or like give up your token in exchange for the shampoo directly without going through USD, like actual USD, then that would be a different story. So the further that DeFi gets towards being able to use the actual token for the transaction, the further away you get from being taxed, I think.
Shit. Hey, go ahead. Yeah. Yes?
Hi, two questions. The first one is, how do you envision the crypto space changing in the next 3 years? And the second one is, as a developer yourself, what's the biggest advice you could give to like a college senior or junior looking to break into the space?
That's a very good question. So in the next 3 years, I see a lot of trends forming, starting from right now. So I think people say crypto is different, but I think crypto is like pretty much the same as any other traditional finance. It's just following the same footsteps. So if you look at traditional finance, like how it evolved is firstly there were payments, like you use money, spend it, and then there were like spot money markets. You can lend money, you can deposit money and have someone else lend it to some other people and then gain interest on that. And then right now we have a situation where the derivative market determines pretty much all of the prices. A lot of the liquidity is stored in derivative markets. And I believe crypto would follow the same. Right now, like I won't say payments is too well adopted for cryptocurrencies, but we do have spot money markets. We have Compound, Aave, we have Anchor. We have those protocols. And I think the next rational step would be derivatives. Because to be honest, crypto is currently all about speculation. So if the market demands speculation, then most of the products will be developed to support and make that demand much more efficient. And other things would, is that a lot of crypto people hate regulation, but regulation is something that cannot be avoided. So I see a trend of more custodians and banks being involved. So yeah, I would say custodians will also play a good role here. And for the developer advice, I myself isn't actually like a developer myself, but if you really want to do full-time crypto, and if you have like a vested interest on it, then I would say like first join any promising projects, and then like they would be happy to convey all of the knowledge they have over to you. So you'll have a good understanding of how the market works here. And afterwards, you will have a lot of insights to determine which of the stuff are good and which of the stuff are bad. And you'll be able to figure out if I were to start like a crypto business, this is like the thing that I should be doing. And yeah, I think that's like a good plan. Oh.
I just realized we didn't go over that.
Yeah, so like I've been doing blockchain for a couple years. I guess I was mostly focused on research like initially, and back in 2019, I started like a company that developed on the idea of liquid staking, and which was actually hired by, early last year by Terraform Labs, the Terra company, to create Anchor protocol. So that's a bit of my life story. Oh, by the way, if there's any like, the questions don't need to be like stablecoin specific.
Yeah.
Like,
If you wanted, yeah, if you have questions, when we went over lending and borrowing, so I put the slide up, about like exactly, we went over these protocols, if you want to go over how it exactly works. There was a question about why you would choose to put your money in a liquidity pool when you could put it in one of these protocols, for example, and earn a higher interest rate or a more stable interest rate. Maybe you can talk about because I know you have liquidity pools in here, and you also have the lending protocol. So what's guiding a user's decision of where to place their money?
yes, that is actually a problem within the field. So a lot of the decentralized exchange protocols out there, they tackle the problem by incentivizing people to provide liquidity to their DEX. And right now, like, yeah, I won't say the market is too efficient. So there's like a battle between whether you gain better yield by lending on like Compound or Aave money market protocols, or you provide liquidity on Uniswap or SushiSwap or Balancer. And although you suffer impermanent loss, there's a chance of you losing money. You'll get much higher yield from the token incentives and also the trading fees that you accumulate. Yeah, so the battle is still ongoing. A lot of the things in DeFi right now is driven by the token incentives that I mentioned, but most people vision that to be a short-term event, and eventually, eventually there'll be a lot of usage, which would be sufficient enough incentive for regular people to just provide liquidity. Yep.
What's the top 3 coins you would recommend someone to invest in?
Terra.
I asked, yeah, that's why I asked for 3.
I see.
This is not official Terra investment advice.
Yeah.
Nor is it ours.
Nor is it ours.
Yeah, but focus on the technology and like focus on the rationale behind. I'm not saying like you should be investing in Terra, but like it applies to every investment you make. Check out the fundamentals and check out the team and check out the execution capabilities, because like even for protocols, it's still a product. It's all about the team behind executing. So I think most of the investment rationale should be based on that as well.
All right. Oh,
Oh my gosh. 2 more hands.
I think the rest of the questions you guys can come up to the front and ask him directly. Please pull out your computers right now and do the attendance quiz. The attendance code is RAT for Ratan. Caps matter, so it's all caps. Give a big round of applause to Ryan. Sorry. There are more questions. Please come up. We'll stick around for a little bit after class. Start thinking about your final paper. Discussion due next week. And do the mid-semester feedback form. Thank you.